Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Thursday, the 14th of November 2024. So as usual, before we start our Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape yesterday in terms of the news flow and as well as the various broad-based cross-asset intraday performance. Okay, so let's start with the news flow first and economic data release. So yesterday's important economic data release will be pertaining to the US inflationary trend over here. So let me have a quick glance at the inflationary trend of what has taken shape for the month of October. So not too scary in terms of the inflationary situation in the US. So what we could see over here is that at this point in time, the core inflation rate year on year still came in within expectation, okay, of 3.3%. Very similar pace of what was actually recorded in the previous month of September. So if you were to look at the core inflation rate over here, okay, it's almost the same. I mean, it didn't rise and didn't fall, right? So it came within expectation. And what's interesting over here is that I want to share with you all the services component of it, right? So if you look at the services inflation year on year, over here, it's also rather flattish as well, 4.7% year on year. So what we could see over here is that inflation trend at the moment in time is still being contained at this juncture. And what you could see in terms of the pricing of the CME FedWatch 2 over here, the pendulum doesn't really change much. It still continues to remains, we call it the market pricing, still looking for a Federal Reserve Fed funds cut in the December meeting. So how do we know that? By looking at this CME FedWatch 2, based on the calculation on the pricing of the various Fed funds 30 days futures contract. So they're looking at a rather high number of 82.8%. All right, chance. So what I could see is that after yesterday's core CPI data and as well as the services component of it came in within expectation, it didn't actually rose, and that actually increased the odds of another 25 basis point cut that's being priced in by the 30 days futures Fed funds futures contract for the 18th of December FOMC meeting. To put it a rather high chance that high probability that the Fed will do another potential 25 basis point cut to bring the Fed funds rate to 4.25% to 4.5%. So the probability increased from 58% that was seen a day ago. All right. So bear in mind over here, this data over here is not really that live data. It's slightly delayed about 1 to 2 hours, but it should be sufficient enough for us to give us the pricing of the 30 days Fed fund futures, how the market implied probability of this chance of a Fed cut on whole or a Fed hike. But if you look at going down the road, that means across the curve heading into 10 months later from here, the market is still only looking at 2 Fed funds cuts for next year. Previously, before Trump or before the US presidential election, market is looking at around as most as sometimes stretching to 3 and even 4 interest rate cut for next year. But that has greatly been reduced after potential what I explained earlier on in my previous daily dose that Trump proposed policy is rather inflationary in nature. So what I could see is that next year during March, there will be a potential chance of a 66% chance of another 25 basis point cut to bring it down to 4. Okay, let me expand it so that you guys could have a better view. Yeah, this should be large enough. So potential cut on 18th of December, then 29th of July next year, no change because it's a very high chance of 87% chance to remain the same at 4.25%, only a small chance of 12% market is expecting a cut, then the larger chance or higher chance of 67% based on the current Fed Funds futures contract curve pricing as being compiled by the CME Fed Watch 2 is indicating that the first 2025 Fed Funds potential cut will only come in March, 19th of March. Then thereafter, May and June is stamped, no change, and another potential cut may come in on the 30th of July 2025 FOMC meeting at a slight higher chance of above 50% at 57% to bring it down to 3.75%. Then thereafter, it will continue to stampede all the way until the end of the year. So what based on market pricing over here is that market is now looking for a rather short interest rate cut cycle. And this short interest rate cut cycle will come in with very shallow interest rate cut as well. All right, so why the market is now pricing in such very short interest rate cut is because markets are forward looking, and due to this particular chart over here on share is the push up of the inflationary expectation. All right, so basically some of you all may look at this. I already shared this chart a couple of times in my intermarket dynamics when I covered the intermarket dynamics segment on my previous daily dose, that the Federal Reserve officials or the market participants are looking at this forward-looking inflationary expectation in the US that also is being priced accordingly to how I put it away, accordingly to market transacted pricing on the US Treasury inflation protected bonds. Then from there, we're able to get the derive of this break-even inflation rate. So take away that this break-even inflation rate on the dark blue and the light blue. Dark blue is 5-year, the light blue is 10-year. Those are forward-looking inflationary expectation. That means, i.e., what will be the probability of inflation rate will be 5 years from now and 10 years from now based on market transacted prices on the US Treasury inflation protected bonds. All right, so what I could see is that both of them has been rising steadily in the last 4 weeks or so. 5-year forward inflation expectation, the break-even rate at 2.42%, the 10-year at 2.35%. The net market is not expecting forward-looking inflation expectation to rise instead of fall. Yesterday's core CPI data is based on backward looking, but market now is expecting inflation trend in US is no longer trending downwards, but slowly gently trending upwards away from the long-term Fed FOMC goal of achieving a long-term stabilization interest rate at 2%. All right, so with this push up in the 5-year and the 10-year break-even inflation rate, i.e. future inflation expectation, that's why market now is looking at a rather short interest rate cut cycle by the Fed and also a very shallow interest rate cut cycle by the Fed. So that also explained to us why the dollar is rising yesterday. So the dollar continues to rose yesterday within our expectation and hit close to a 1-year high based on the dollar index over here. So the dollar index very clearly it broke above this major resistance zone of 105.50, 106.37 over here. So this is the US dollar index. Okay, it broke above this level. It is the daily time frame chart. Very clearly it broke above. So this was previously a major congestion area since the low of 14th of July 2023, and it broke above it. So this more than about, we're talking about 1 year and 3 months kind of consolidation. It broke out, and this bullish breakout over here is that in a very medium term perspective, that means from a multi-week to multi-month perspective, it seems to us that it's being supporting this persistence US dollar strength going forward. All right, US dollar strength going forward. Also, this push up in the US dollar index came also being supported by a push up in the longer term risk-free rate, which is the 10-year US Treasury yield. So yesterday, it attempt to actually already break out this major bullish flag consolidation, we in a long-term circular ascending channel that is in place since March 2022 pandemic low, and right now it's looking for the break at that 4.49% level. So a breakout, a further push up with a daily close above this level by today, end of the US session today, potentially we could start to see from a week to multi-month perspective, the next key resistance will be at 5.2%. So the thing over here is that we got to be a bit cautious right now, especially what we could see over here is that we know that at the moment in time there's this Trump trade that's going on. Okay, so Trump trade over here is looking for a strong dollar, which is picking up steam over here, and also looking out for a push up in the US Treasury yield that causes the dollar to strengthen. Okay, but the negative impact of it will start to actually creep into the equity market. So if you look at the equity market performance yesterday on the US equity market, why? Because if you look at the American first policy that Trump is advocating, that causes the very strong push up in the US benchmark stock indices ranging from the Russell 2000, the Dow Jones, the S&P, and the Nasdaq. Previously, the Nasdaq was lagging, but it also managed to hit a fresh all-time high last week. But this American first Trump trade narrative towards the major US stock indices, at least from a short-term perspective, now has started to dissipate slightly. Why? Because if you look at the past 2 days, the S&P 500, the Nasdaq, the Dow Jones, and the Russell has started to show this kind of lackluster performance. All right, where you start to see the mega cap technology stock underperforming yesterday. The Nasdaq 100 is down negative 0.16%. The Russell 2000, that is part of the Trump trade narrative, where Trump policy will tend to more favor the US small cap company from a longer term perspective due to the generous corporate tax cuts and as well as the trade tariffs against the rest of the world, has started to underperform yesterday as well, negative 0.94%. So only the SPX and the Dow Jones managed to shape very minute gain of 0.11%, and I would say the SPX ended almost unchanged because it's only recorded 0.02%. So what we could see over here is that why the reason is starts to hit the S&P 500 is because of number one, valuation. Okay, because if you start to see a very high US 10-year Treasury yield, the risk-free rate, a higher risk-free rate will actually cause the valuation of US equity to be lower from a fundamental perspective. So that's explain why market participants are getting quite a bit of we call it cautious by doing this kind of profit-taking activities, at least in the short term, that is now impacting the US major stock indices. Then from a short-term trader perspective, definitely this gives us a potential opportunity to actually put away that to actually ignite some short-term technical trading strategies by doing that mean reversion decline scenario that could potentially play out. So later I'll cover up that during the short-term intraday technical outlook on the major US stock indices. All right. So, and also the reason because of the 10-year US Treasury is pushing up higher, gold price got hit as well. So gold price itself previously was part of the Trump trade narrative as well. Why? Because if you look at gold, gold previously was being used as a hedge due to a widening of the US budget deficit from a medium-term to long-term perspective. But because of the US 10-year Treasury yield keep pushing up higher, the cost of holding gold also increases as well, the things of opportunity cost. So that's why you see gold starts to shape that profit taking. Yes, yesterday we see a bit of bounce coming in at the 2,600 level, but the bounce can't able to maintain during the US session and it plunges below it, 2,600, 2,580. So where will gold next in terms of the short-term technical level? Later I'll cover during the short-term intraday technical outlook. All right, and that is what has taken shape yesterday. All right, so now let me share with you one particular intermarket dynamics, okay, pertaining to this very strong dollar over here. All right, so this particular chart I'm sharing with you all is on the weekly chart. So these lines over here, what I did is a ratio chart between the major the major ETF, equity ETF against the S&P 500. So take a view as the S&P 500 as a gauge of the US stock market. And the first ratio here is, we call it in turquoise green, is MSCI Asia x Japan benchmark indices equity divided by the SPX 500. The one in black or dark blue is the MSCI all country world excluding US. That means everything, the developed nation excluding US, divided by the SPX 500. And you have the MSCI emerging markets EM, that's including of China, Indonesia, Brazil, divided by the S&P 500. And you have Japan, MSCI Japan, divided by the S&P 500. So why do I put Japan over here is that because we know that the previously, I mean, there is some form of what I call that narrative that we start to see a very weak yen. That means dollar yen keep on going up, which came in with our expectation as well, breaking above the 154.70, 154.80 level yesterday. The Nikkei 225 or the Japanese stock market should actually rally as well, but that may not be the case always. So what you could see over here is that if I will put it in a ratio format against the SPX, all the major regional stock benchmark indices ranging from Japan, emerging market, developed nation, again excluding US, and Asia ex Japan, that's including Singapore, Australia also, is been now greatly underperforming the US market. Why? Because of the dollar is strengthening, and the dollar has starts to shape a breakout by this derivative rate of change. So what I did is that it's a dollar index, but this is a rate of change of the dollar index. It's a 5-week rate of change. So we realize that the rate of change has started to stage a major bullish breakout since the 9th of May, since May 2022 consolidation. It break, retest, and it bounced up again this week. So what you could see over here is that the dollar strength in terms of absolute, by looking at the dollar index, and in terms of its derivative, that means a rate of change chart, is indicating that this push up over here, prior to that, it formed a very long-term consolidation pattern. It starts to do a bullish breakout after this long-term consolidation pattern, igniting potentially more persistency, higher duration of dollar strength going forward potentially, and that could potentially impact other performance of all the world stock market against the US. So what I mean over here is that it doesn't mean that the US can go up because everything is being so-called interconnected. So if the fear of this longer term US 10-year treasury keeps going up higher and higher, the only way the US stock market can keep going up over here is that market participants believe that US economy is able to generate higher earnings growth for US stocks that could surpass the rate of increase of the US 10-year treasury yield, unless that happens. All right. So if that doesn't happen, the US stock market could potentially fall as well, but they will potentially fall at a lower magnitude compared to the rest of the world, as indicated by the ratio chart over here. All right. So this is the intermarket dynamics I'm going to share with you all that is emerging right now, that could potentially last for a multi-week to multi-month time frame. All right, so with that, now let us now jump straight into the short-term intraday technical outlook on the various broad-based cross-asset classes. So before we do that, as usual, let me expand my screen first. Okay, so now let's start with the FX market. All right, so starting with the FX market over here, let's take a quick look at the euro dollar. Okay, still recall that euro dollar previously yesterday we looked for a minor mean reversion rebound within this short-term downtrend phase that's still intact. So the bounce actually came close to the resistance zone that we highlighted, which was at 1.0660/1.0680. Yesterday it printed a high of 1.0655. Right, almost hit there. Then after it plunges below it. Right, so what you could see over here is that this bounce the mean reversion bounce more or less has already hit the objective. So with that, we will flip back to a intraday bearish bias on the euro dollar using yesterday's mean reversion bound resistance zone as my short-term pivotal resistance level for today, 1.0660/1.0680. As long as this level didn't surpass to the upside, potentially the euro dollar could potentially shape lower low. Next near-term support level to watch, 1.0520 followed by 1.0470, maximum 1.0410, which is the lower limit of this minor descending channel, and the 1.618 Fibo extension level taken from the high of 6th of November. Only a push up and an hourly close above 1.00680 will invalidate today's intraday bearish bias to see another round of much more pronounced minor mean reversion rebound scenario taking shape again, exposing the next near-term resistance level at 1.0720 followed by 1.0770, which is the correspond to the downward sloping 20-day moving average, acting as a resistance level as well. And as well as this dotted green line here, which is a former major range support level, now turns into a pullback resistance. So this range support level, the symmetrical triangle range support level, was drawn from the low of 8th of October this year, right? So that's for the euro dollar, flipping to a intraday bearish bias, given that the mean reversion resistance level has really been made yesterday. Now, turning our attention will be the sterling dollar. So the sterling dollar continues to plunge lower as expected, coming close to our second support level, or the second support level that we highlighted, breaking below the 200-day moving average. So with that, I will actually tighten the key short-term pivotal resistance for today at 1.2785. All right, over here. Okay, this kind of congestion zone here, and very close to the yesterday's US session high as well. So as long as any bounce didn't surpass 1.2785, we will still maintain that intraday bearish bias on the sterling dollar, looking at the next near-term support level to come in at 1.2620/1.26 figure. Below it exposes the major trend line support level of 1.2560. So what do I mean by that? If you go to the daily chart, okay, this is the trend line that is in place since 9th of March low 2023. All right, only a push up and an hourly close above this tightened key short-term pivotal resistance that we have for today at 1.2785 will invalidate today's intraday bearish bias to see the start of a mean reversion rebound scenario within its short-term downtrend to expose the next near-term resistance level at 1.2845 and even 1.29 figure level next. So that's for the sterling dollar, still maintaining our intraday bearish bias. Now, turning our attention will be the Asia Pacific currency against the dollar. Starting with the Aussie dollar. So the Aussie dollar continues to actually plunge down lower, hit our first support level at 64.75/64.70. So no signs of a bearish exhaustion yet. So we'll still maintain that intraday bearish bias. So expect for perhaps a bit of bounce at the first intermediate resistance level at 65.14, maximum 65.60 level over here. So you look at what is this 65.60. So if I were to actually do a trend line, graphical minor trend line resistance level. Okay, so this is the first one, 65.14. So I don't want to tighten it so tight over here. So I'll use this congestion area here, 65.60. So as long as this 65.60 short-term pivotal resistance is not surpassed to the upside, we'll still maintain that intraday bearish bias on the Aussie dollar, hitting towards the next level at 64.40, followed by 64.10, 64 figure level. So what's this 64.10, 64 figure level? Is rather important. It's a major support level on the Aussie dollar. So if you go to the daily chart over here, is in fact this major ascending trend line taken from 2 years ago, 13th of October 2022. Okay, so if we start to see a clear bearish breakdown below it, that means with a daily close and better still a weekly close below this level potential, that means we may start to kickstart a kind of a multi-week to multi-month impulsive downward movement or bearish movement for the Aussie dollar. All right, so now back to the hourly chart. So only an hourly close and a breakout above 65.60 short-term pivotal resistance will invalidate today's intraday bearish bias, potentially seeing a mean reversion rebound scenario, exposing the next near-term resistance level at 66-figure level, which coming very close to the 20-day moving average. Above it sees 66.40, which is previously this failure bullish breakout, and come also very close to the 200-day moving average, acting as a close proximity or as a resistance level at 66.40 as well. Okay, so that's for the Aussie dollar, still maintaining that intraday bearish bias with a tightened short-term pivotal resistance for today at 65.60. Now, flipping our attention will be the dollar yen over here. So the dollar yen over here yesterday surpassed this previously that the 54, this level here, the 54.70, the 54, this level, the 54.70, 54.80, surpassed it, then came down, did a test and bounced back again now over here. So with that, I'll be using this zone here as my short-term pivotal resistance zone over here, now coming very close to our second resistance that we highlighted yesterday after the 54.70, 54.80, which is the 56.20 level. So potentially there could be a bit of a minor pullback. So as long as this minor pullback didn't surpass this tightened short-term pivotal support zone at 154.40/153.95, we'll still maintain that intraday bullish bias on the dollar yen, with the next resistance zone coming in at 15770/15835 over here. So if you go back over here is the congestion area previously on the 16th of June and 18th of June. So this 158.35 is pretty much more obvious on the daily time frame. Okay, over here 158.35. Okay, this congestion area. So now back to this hourly time frame again. So unless price action that pullback starts to break down below 153.95, and this 153.95 also, if it breaks down, it actually implies a bearish breakdown of this minor ascending channel support, or medium term ascending channel support since the low of 30th of September, because it's more than a month, right, already that has been evolving in this ascending channel. So that could potentially indicate the start of a potential corrective decline scenario, at least from a multi-day perspective, to mean revert it back towards the 20-day and the 200-day moving average, with the next support level to focus on after the break of the 153.95 will be 152.70, followed by 151.55, 151.30. Okay, 151.55, 151.30 over here. Okay, so that's for the dollar yen. All right, with that, let us now focus our attention to the major stock indices. All right, starting with the Asia Pacific indices, which is the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index, no change. Price action can't break above the first resistance that we highlighted yesterday at 18,880, and 20,150 is our short-term pivotal resistance level to maintain that intraday bearish bias. So still keep these two levels intact over here, because price action hasn't broken below the first support level at 19,455. So I don't want to tighten the pivotal resistance too tight at 19,880. Still using 20,150 as my short-term pivotal resistance on the Hong Kong 33, i.e. the Hang Seng Index, maintaining that intraday bearish bias below 19,445, exposes 19,080, followed by 18,740 next. Only an hourly close above 20,150 will invalidate today's intraday bearish bias on the Hong Kong 33 to potentially see a squeeze up to retest the 20-day moving average, acting as a resistance as well at 20,490. Above it sees the range stop at 21,050. Right, so that's for the Hong Kong 33. Now, turning our attention will be the Nikkei 225. So Nikkei 225, due to mixed element yesterday, we have a neutrality stance, so we turn neutral. So yesterday, the Nikkei 225 broke below the neutrality limit at the 39,090, and what it did over here is that it actually break and did a retest at this former descending trend line support from the low of 28th of October, now turns into a pullback resistance level. So with that, I'll be using the 39,090 as my short-term pivotal resistance on the Nikkei 225 or the Japan 225, flip to an intraday bearish bias. We in this still complex sideways range configuration that is in place since the low of 30th of, I would say 27th, okay, 30th of September. All right, it's still inside this complex sideways range. So right now, it's likely reintegrating back into the lower limit of this sideways range. So taking things one step at a time, a breakdown below the 200-day moving average, which is at 38,670, potentially exposes the next near-term supports level at 38,265, followed by 38,000 figure level. Only a potential, only a hourly close and a breakout above 39,090 will invalidate today's intraday bearish bias within this sideways range configuration to allow it to float back up towards the upper limit of this sideways range. First resistance to watch out for after 39,090 will be 39,550. Above it sees the all important range resistance at 40,155 / 40,280. All right, so that's for the Japan 225, flipping to a intraday bearish bias today within this month long of sideways complex range configuration that is still evolving. Now, turning our attention will be the German DAX or the German 30. So German 30 yesterday, we looked for a mean reversion bounce to take shape. So the bounce actually hit the first support level, but it didn't go much further to 19,260 and 19,350. And instead, it broke down below this descending triangle range configuration yesterday during the US session and did a retest back up again. And after that, there's a bearish reaction of it. All right, so the first resistance level to watch out for will be 18,970, 19,023. So that is kind of a pullback resistance of that descending triangle range support that has been taken out and retested again yesterday. So I don't want to use this level as my short-term pivotal resistance. It's a bit tight, so I'll use yesterday's first resistance level that made and did that bearish breakdown thereafter. All right, there's this inverted V shape, all right, that occur. So it also correspond to the 50-day moving average as well. So 19,140 will be my short-term pivotal resistance. Flip to a intraday bearish bias on the German 30 after a break below 18,850 may expose the next near-term support level at 18,685. Only an hourly close and a push up above 19,140 will invalidate today's intraday bearish bias to see a reintegration back above the upper limit of that descending triangle range configuration again. Next near-term resistance level to watch 19,260, followed by 19,350, maximum the upper limit of this descending triangle range configuration, 19,510 / 19,560. All right, so that's for the German 30. Now, turning our attention will be the US Wall Street indices or the US Wall Street index, which is the Dow Jones Industrial Average. So the Dow Jones Industrial Average yesterday managed to survive at the support bounce, but the price action is getting less bullish and also be indicated by the RSI as well. So if you look at the RSI, it continues to shape a series of lower. All right, then this low is lower as is as well, so indicating the lack of bullish momentum. So given that this latest price action that is indicating this lack of bullish momentum, I will be less convinced right now to actually see the US Wall Street 30 to shape higher high or to see fresh all-time high. And right now, rather instead, it may now do that mean reversion decline to retrace that rather steep up move that was seen in the aftermath of the US presidential election last week. So using yesterday's bearish reaction level at 44,220 that it can't surpass. So recall that yesterday this level was a resistance that I mentioned that it got to surpass very quickly in order to allow the boost to gain the upper hand, but it can't do so yesterday, and in the end it started to print a series of lower low or lower high on the hourly RSI. So I'll be using this rejection level 44,220 as my short-term pivotal resistance for today on the US Wall Street 30. Flip to a intraday bearish bias for a potential minor mean reversion decline scenario to unfold in the first step. First support level to watch out for 43,700, followed by 43,370, maximum 43,060, which correspond to the rising 20-day moving average. So it's like a mean reversion magnetic potential pull down back towards the 20-day moving average. All right, overall the medium term trend and is still up because price action is still trading above the 20 and the 50-day moving average. All right, so right now we are now looking at a potential mean reversion decline first in the first step, and we see how the price action develop once it come close to the 43,060 level. Only an hourly close back above 44,220. That means with a breakout of an hourly close above 44,220 will invalidate today's intraday bearish bias and resume the impulsive up move. Revisit target potentially seeing the next resistance coming in at 44,700 / 44,730, followed by 44,990 next. Okay, so that's the US Wall Street 30. Now, turning our attention will be the Nasdaq 100. So very similar for the Nasdaq 100 as well. Yes, it managed to survive that at the short-term pivotal support here, but it can't break above that resistance that we highlighted yesterday that it got to surpass fast before resuming a series of higher highs. So like the Dow Jones Industrial Average, the US Wall Street 30, now is facing the risk of a lack of bullish momentum, and it could kickstart that mean reversion rebound for that magnetic pullback towards the rising 20-day moving average again after last week's steep up move. Yeah, so using 21,220 as my short-term pivotal resistance level, we will flip to a intraday bearish bias, a breakdown below yesterday's swing low at 20,990 exposes the next short-term support level to watch, 20,865, 20,640, maximum 20,500, which is the rising 20-day moving average. Right, and in fact, if you look at the hourly RSI, it also starts to shape this series of lower high as well. Okay, indicating the lack of upside momentum. Only an hourly close with a breakout above 21,220 will invalidate today's bearish bias to resume the impulsive up move for the next resistance to come in at 21,390, followed by 21,500. All right, so that sum up the intraday technical outlook on the major global stock indices. Now, turning our attention now will be the commodities market over here. So let's take a look at gold XAU/USD. Still recall that gold XAU/USD yesterday we're looking for at least a bounce, a mean reversion bounce, but this bounce didn't actually even surpass the first resistance at 2,626, and thereafter it plunges downwards over here. So if this plunge downwards over here, it's very clearly a medium-term bearish breakdown, with the breakdown of this former medium-term, I would say, ascending channel support from the low of February 2024 this year. All right, so with this breakdown of this medium-term ascending channel support, or from this medium-term channel, very likely right now we will start to see further potential weakness on gold XAU/USD to unfold. Like I mentioned again, it's due to that very persistent firming up move that's being seen on the 10-year US Treasury yield, putting up upside opportunity cost of holding gold. And we know that gold doesn't generate any fixed income coupon, all right, over here. So with that, yes, the RSI is now back to the oversold region again, so there may be some form of potential bounce, minor bounce. So as well, this minor bounce didn't surpass yesterday's medium-term bearish breakdown zone, which is my pivotal resistance level for today, 2,590/2,600. Flip to a intraday bearish bias for gold XAU/USD. Two resistance level to highlight on the near-term basis, 2,546/2,526, followed by 2,500 figure level, which is the 1.382 Fibo extension on the downside from here, taken from the high of 31st of October, and as well as this minor congestion area here of 9th of September and 11th of September. Only hourly close back above 2,600 pivotal resistance level, then we will say that this is a familiar medium-term bearish breakdown to see the price action staging a much more pronounced recovery, given that if it goes above the 2,600, it's a familiar bearish breakdown, then we could see much more meaningful short-term recovery in first step towards 2,625, followed by 2,650 next, which correspond to the 50-day moving average, I think, as a resistance level. Okay, so that's for gold XAU/USD. So with that, just give me a couple of seconds. Let me load up the chart of West Texas crude oil from here. Okay, Okay, so for West Texas crude oil price action continues to actually wobbled. No signs of a short-term or medium or even intraday bullish reversal configuration. It hit the first support level again, then it bounces off from here. All right, so with that over here, I will still be using this level here as my first resistance level to watch, 69.50, as long as the bounce didn't surpass 70.25, which is my short-term pivotal resistance level, which will correspond to the downward sloping 20-day moving average. The next near-term resistance level to watch out for below 67.10 level will be the all-important 65.70. So why 65.70 is important for West Texas crude oil? Because 65.70 is the lower limit of this major descending triangle range configuration that is in place since 20th of March 2023 low. All right, so if we start to see a bearish breakdown below 65.70 with a daily close below it, then potentially we may start to see a much more pronounced decline in West Texas crude oil that could last from a multi-week perspective. All right, because this is a daily time frame chart with a bearish breakdown from the 65.70 level. So on the intraday basis, you are taking things one step at a time first. So still looking at after 67.10 breakdown, the next near term support level on the intraday basis will be 65.70. Only a price push up back above 70.25 will invalidate today's intraday bearish bias on the West Texas crude oil to see a much more steeper, meaningful mean reversion rebound scenario unfolding back towards the first half of this, the middle part of that major descending triangle range configuration, with the next near-term resistance level to watch on the intraday basis after 70.25 will be 71.25, followed by 73.15, where price action can't break since a test of it on 24th of October. All right, so still maintaining that intraday bearish bias on the West Texas crude oil. All right, so that also covers the intraday technical outlook of all the broad-based cross asset classes that I wish to share with you guys. So before we go, let's have a quick look at the economic calendar of what are the key data or event to look out for today. All right, so today will be Thursday. Over here. Okay, so over here, during the European session, there's a couple of there's this European data that I want to take note of will be the kind of a employment change data, all right, that is out at 6 p.m. Singapore time. GDP growth rate shouldn't be much more of a key event again, because this is a second estimate now, because the previous preliminary estimate has been released about, I think, 2 weeks ago. So this shouldn't be a impactful event. All right, so take note of the employment change, which is the flash figure, which is out at 6 p.m. Singapore time for Eurozone. And thereafter, you have PPI in US, so that's considered as the factory gate prices, 9:30 p.m. Singapore time. Over here, then continue by this weekly jobless claim, indicating the health of the labor market in the US. Okay, then thereafter will be a Federal Reserve official speaking, Fed working at 10:15 p.m. Singapore time. All right, then what you have over here is early morning, 12 a.m. You have the weekly EIA crude oil stockpile change that could potentially impact the West Texas crude oil intraday price movement. That will be 12 a.m. Okay, then heading into, yes, at 4 a.m. This is very important. So this is Fed Chair Powell's speech, the boss itself, and followed by I think that there should be some conference. Then at 5 a.m. you have Bank of England Governor Bailey speech over here. All right, and heading into the early Asia session, 7:50 a.m. Singapore time, you have Japan GDP growth. This is the flash figure, the first flash release at for Q3 at 7:50 a.m. Singapore time. All right, so then thereafter, at 10 a.m. you have a slew of key China data that could potentially impact the Hang Seng Index, which is the housing price, the industrial production, the retail sales, and even the unemployment rate at 10 a.m. Singapore time, up on Friday, early Asia session. All right, 15th of November. So, yeah, that should sum up today's daily dose of market insight. I'm Kelvin here. So just give a heads up, I'll be away tomorrow, 15th of November, for more than a week or so, and I'll be back only on the 26th of November. Okay, so from 15th of November, I'll be away. I'll be back on the 26th of November. So daily dose will only be resumed on Tuesday, 2 weeks from now, a week from more than 2 weeks from now, on the 26th of November. So we shall speak again on the 26th of November. Do have a great week ahead. And with that, I'm Kelvin here, signing off. Thank you.